Hey everyone, before we dive in, here's something really cool. You're listening to an episode created almost entirely by AI. From the script to the voice, this is part of the AI Takeover series by Blockchain DXB, where we explore what's possible when humans hand over the mic to machines. There's little to no human involvement, and that's what makes this episode so powerful. Welcome to the future of content creation. Let's get into it. This episode is powered by Amana, the region's first and fastest growing regulated all-in-one trading and investing app. Whether you're looking to invest in US stocks like Apple or Tesla, or MENA giants like Adinoc or Salik, Amana puts the financial market at your fingertips. You also get access to gold, foreign exchange, ETFs, futures, and commodities. With over 375 assets to choose from, they've got the largest crypto selection in the region. And listen, guys, if you want to build long-term wealth without thinking about it every day and want to automate your investing, just set your monthly budget, choose your preferred categories, and let Amana do the rest. No fees, no lockups, and 100% customizable. Even better, funding your account is frictionless, and funding your account is easier than ever. You can fund your account with Apple Pay, Google Pay, credit cards, instant bank deposits, and even your crypto wallet. No friction, no hassle. And if you get stuck, Amana offers 24/6 real human customer support and personalized sales assistance. Because you're part of the Blockchain DXB community, you get an exclusive offer. Register with the code BlockchainDXB and make at least one trade to receive a $100 trading bonus credited to your account the following month. So what are you waiting for? Download the Amana app now. The link and code are in the show notes. Next up, Blockchain DXB is proud to be the official media partner for one of the biggest blockchain events of the year, the Blockchain Futurist Conference. For the first time ever, North America's leading crypto event is heading to the United States, taking place at the iconic Guitar Hotel at Hard Rock in Hollywood, Florida. Alongside it is ETH Women, happening simultaneously. Expect multi-stage panels, NFT galleries, DeFi showcases, tech demos, metaverse experiences, and more, all under one roof. It's where the smartest minds in blockchain, crypto, and AI will converge. Get 25% off tickets by using the code DXB25. And yes, I'll be there with exclusive live coverage, behind-the-scenes interviews, and spotlight features on groundbreaking projects. Mark your calendars, November 5th and 6th, 2025. Visit futuristconference.com and use code DXB25. Link is in the show notes. Next up, Blockchain DXB has two more interesting partnership news to announce. First up, with Future Blockchain Summit and Fintech Surge 2025. Blockchain DXB is an official media partner of Future Blockchain Summit and Fintech Surge 2025. Future Blockchain Summit is one of the biggest and oldest blockchain summit taking place in Dubai, going back to almost a decade, 2017 to be precise. The event takes place between October 12th to 15th at Dubai Harbour. This is where blockchain meets fintech to redefine the future of finance. 250 plus world-class speakers, 1,200 plus investors, live demos, product launches, and the exclusive invite-only GITEX Digital Assets Forum, all under one roof. From Web3 pioneers to fintech leaders shaping payments, banking, insurtech, AI, and DeFi, this event brings the entire ecosystem together. Startups, this is your launchpad. Get in front of top VCs, accelerators, and industry leaders. For blockchain and fintech companies, this is where connections turn into partnerships and dreams turn into exits. Register today at futureblockchainsummit.com. Don't just watch the future unfold, own your space in it. Remember, Future Blockchain Summit and Fintech Surge 2025. The registration link is in the show notes below, and see you at Dubai Harbour. Second partnership news kicking off from today is with the leading Bitcoin event organizers on this planet. And this year, Bitcoin Asia is taking things to another level. Bitcoin Asia are hosting a massive gathering this August in Hong Kong, and Blockchain DXB is proud to be an official media partner of Bitcoin Asia 2025. Taking place this August in Hong Kong, Bitcoin Asia is the region's premier Bitcoin gathering, where builders, investors, and innovators meet. It's really an honor for Blockchain DXB to be associated with Bitcoin Asia. Now at this event, expect powerful keynotes, bold conversations, and a headlining session with none other than Eric Trump. He will be sharing his vision for Bitcoin's long-term potential, its role in global finance, and Asia's massive impact on adoption, and a lot more. So listen up, guys. From infrastructure to regulation, privacy tools to lightning development, Bitcoin Asia connects global Bitcoin communities and drives innovation across cultures and markets. And as part of this partnership, you can register for the Bitcoin Asia using the code DXB. All the details are in the show notes below. If Bitcoin's in your blood, this is your event. So, register today at asia.btc and don't forget to use code DXB for 10% off your tickets. Bitcoin Asia 2025, Hong Kong is calling. Be part of the future of Bitcoin. Next up, Advanced Media is the largest distributor of professional video, photography, cinema, and broadcast accessories in the Middle East. They represent over 100 major brands, including DJI, Hasselblad, Red, and Rode. The mic I'm using to record this? Sponsored by Advanced Media. But what really sets them apart is their commitment to purpose. People, planet, and prosperity. That's not just branding, it's their actual business model. They've partnered with SAE Institute in Dubai to offer scholarships to students pursuing a bachelor's degree in filmmaking, each worth AED 50,000. They also run regular workshops, training programs, and tech showcases across the region. For more info, visit amt.t, that's amt.tv. Finally, let's talk about something every crypto investor should take seriously: security. And that's where Ledger comes in. Ledger is one of the most trusted names in crypto security. Their hardware wallets, like the Nano S Plus and Nano X, keep your assets safe by storing your private keys offline. That means you're protected against hacks, malware, and phishing attempts that can compromise online wallets. The company is headquartered in Paris and is constantly innovating. Their team works with world-class security researchers and regularly tests their own products for vulnerabilities. It's why Ledger wallets are used by millions around the world. Using a hardware wallet isn't just smart, it's essential. If you're serious about crypto, it's time to stop relying on centralized exchanges or browser wallets. Click the link in the show notes to order your Ledger wallet and support this podcast at the same time.
Okay, so picture this scenario. You walk into a crowded room, and the vibe is, well, it's awful.
Right.
Everyone is sweating. People are basically shouting that the building is on fire, and the panic meter is just flashing red.
Sounds like a party you want to leave.
Exactly. By all accounts, you should turn around and run. But then you glance over at the VIP section, and what do you see?
Let me guess.
You see the wealthiest, most powerful people in the room, quietly and calmly, carrying massive bags of money directly into the burning building.
Yeah, that is a very visceral image, and unfortunately, it's disturbingly accurate for where we are right now.
It really is.
Okay.
Welcome to the Deep Dive. It is the 22nd of February 2026, and that scenario is exactly what is happening in the crypto markets today.
We are seeing just a complete disconnect between what the crowd feels, which is sheer terror, and what the smart money is actually doing behind the scenes.
It's a paradox.
It is a paradox, and honestly, it's one of the most confusing signals I've seen in a while. I mean, I've been staring at the charts all morning.
Well, we have a massive stack of sources to get through today to try and figure this out for you guys. We're pulling from the latest blockchain DXD market reports. We've got some pretty dense legal text regarding the U.S. Trade Act of 1974.
Which is actually much more exciting than it sounds, I promise.
I'll hold you to that. And we also have some really specific updates from the Middle East regarding G42 and Saudi real estate.
Yeah, the mission today is to connect these dots for you, because on the surface, it just looks like total chaos.
Right.
You have U.S. tariffs, you have this new board of peace, Bitcoin difficulty is spiking to the moon, and capital is seemingly just fleeing DeFi.
But if you look closer...
Exactly. If you look closer, there is a coherent story here. It's a story about infrastructure.
So let's start with the fire. The market sentiment score is currently sitting at 14. For context, that is deep, deep in extreme fear territory. It's basically panic selling mode. What are the raw numbers telling us right now?
The raw numbers are pretty ugly. I won't sugarcoat it. The global crypto market cap has slipped down about 1.5% to $2.38 trillion.
Okay.
And Bitcoin is hovering right around 67,334, so down just over 1%.
So if you just look at the surface, it looks like a standard correction or maybe even the start of a bear trend.
Yeah, and usually when Bitcoin dips like that, everyone assumes the sky is falling.
But you found something in the ETF data that contradicts that narrative completely.
This is where it gets really interesting. While the retail price is dropping, the ETFs...
The institutional products.
Right, the ones managed by the big asset managers like BlackRock, they actually saw inflows of nearly $92 million.
Which is weird, because usually when the price drops, the ETFs bleed money, right? Because regular people get scared and cash out.
That's the retail reflex, yes. But this divergence suggests that institutions are taking the exact opposite bet. Retail investors are reacting to the immediate volatility. They're feeling the fear of the dip.
And the institutions?
The institutions are likely looking at that 14 fear score and seeing a massive discount. They are soaking up the liquidity that all those panic sellers are providing.
So retail is selling the bottom, and BlackRock is buying it. Tale as old as time, right?
Pretty much.
But there is another metric in your notes that worries me a bit, the stablecoin data. I always thought stablecoins were like dry powder, money sitting on the sidelines waiting to buy back in.
They are, theoretically. But the velocity of that money, like how fast it's actually moving through the system, has completely stalled out. Look at Tether, for example, USDT.
Okay.
The market cap is massive. It's over $183 billion.
Which is a lot of potential buying power.
Huge. But the 24-hour volume, it's only around $41 billion.
Oh, wow. That seems incredibly low relative to the size of the whole pot.
It's dismal. And look at FDUSD. It has dropped below $200 million in volume for the first time in ages.
So we have this massive pile of digital dollars, $183 billion, but nobody is moving it. It's just sitting there. What does that actually tell you about the mindset of the average holder right now?
It tells me that stablecoins right now aren't being used as chips at the casino. They aren't using them to buy Bitcoin or Ethereum. They're being used as a bunker.
A bunker? Like just hiding out.
Exactly, a bunker. People, and perhaps even citizens in countries with high inflation or currency instability, they're just hodling U.S. dollar equivalents.
Yeah.
They aren't trying to trade. They are just trying to preserve their wealth against local currency debasement. It's a defensive crouch. They are parking their value and refusing to move.
Which makes perfect sense because the macro picture outside of crypto is frankly terrifying right now. We have to talk about what is happening in Washington.
Yeah, the policy side is wild today.
The Supreme Court just dropped a total bombshell regarding President Trump's tariffs.
They did. In a major ruling, the Supreme Court struck down the president's initial emergency tariffs. They essentially ruled that he exceeded his authority by using emergency powers to impose those broad import tariffs without congressional approval.
And just to be clear, for you listening, we are just reporting on the legal mechanics here, not endorsing any political viewpoints. But knowing this administration, I assume they didn't just say, oh, our bad, we'll stop and move on.
Not at all. The response was immediate. And it's a masterclass in using legal levers or loopholes, depending on how you look at it. Trump immediately shifted strategy to Section 122 of the Trade Act of 1974.
Okay, let's unpack that. Section 122, I feel like I need a law degree just to follow this trade war.
It's actually quite clever from a legal standpoint. Section 122 is a specific provision that allows for a temporary import surcharge, but it can only be used if the U.S. is addressing a fundamental international payments problem.
A payments problem. That sounds like they are basically admitting the country is broke. Like, sorry, card declined.
In a geopolitical sense, yes. They are citing the trade deficit as a balance of payments crisis. And by framing it this way, they completely bypass the Supreme Court's objection about using emergency powers.
So what's the actual tariff number now?
So he initially floated a 10% surcharge, but boosted it to 15%, which just so happens to be the absolute maximum allowed under that specific statute.
So 15% on everything coming into the country.
Correct. But here's the catch, and this is exactly why the markets are so jittery right now, or is temporary. By law, this surcharge is valid for only 150 days unless Congress steps in to extend it.
150 days. That creates a very specific and very tight window of uncertainty. I mean, if I'm a business owner, do I raise my prices? Do I eat the cost? Do I just wait it out?
That is the nightmare for the markets. Markets can handle bad news. They can adjust to a permanent 15% tariff. But they absolutely cannot handle uncertainty.
Right. No CEO wants to make a 5-year plan when the cost of their supply chain might drop back down in 5 months, or it might not.
Exactly. That paralysis is likely contributing heavily to the extreme fear score we mentioned earlier. Plus, we have the State of the Union address coming up on the 24th, so everyone is just holding their breath.
And amidst all this tariff talk, there's this other development in the sources, the Board of Peace. It sounds like something straight out of a dystopian sci-fi novel, but it's real.
It is very real. It was announced last week, currently headed by Trump and involving roughly 25 to 28 different countries. We don't have all the operational details yet, but the framing coming out of Washington is that this is history in the making regarding global cooperation.
So on Monday, we slap 15% tariffs on everyone, and on Tuesday, we invite them to the Board of Peace.
It suggests a very aggressive carrot-and-stick approach to geopolitics, and investors are just struggling to price that in. Is it a trade war? Or is it a new era of global alliance? The market doesn't know, so it freezes.
It is never dull, is it? Okay, let's pivot from the White House back to the blockchain. Because while the price of Bitcoin is wobbly and the politicians are fighting, the network itself is, well, it's going beast mode.
Beast mode is an understatement. We just witnessed a record-breaking spike in mining difficulty. On the 20th of this month, difficulty shot up by 15%.
Wow.
That is the largest single increase since 2021.
And for anyone who doesn't track mining algorithms every day, why does difficulty jump like that?
So the Bitcoin network is designed to be self-regulating. It wants to produce one block roughly every 10 minutes. If more miners plug in more powerful machines, blocks get found too fast.
Okay.
So every 2016 blocks, which is about every 2 weeks, the network adjusts the math problem to make it harder. A 15% jump means a massive, massive amount of computing power just came online all at once.
We're seeing a new term thrown around in the DXB reports too, the zettahash era.
Yes. The network hash rate has rebounded to 1 zettahash per second. To put that in perspective, we were recently sitting at around 826 exahash.
Okay, stop right there. Zettahash sounds very cool, but what does it actually mean?
It's a measure of computing guesses. 1 zettahash is a 1 followed by 21 zeros.
Good grief.
Right. It represents the number of attempts the network is making every single second to solve the encryption block. It is an astronomical amount of energy and hardware.
But here is the squeeze, and this is where I get confused looking at the data.
Yeah.
Price is down. Difficulty is up. That means it's harder to earn Bitcoin, and the Bitcoin you do manage to earn is worth less. Miners must be bleeding money. Why are they expanding right now?
That is the billion-dollar question. The hash price, which is the metric that measures profitability, is near multi-year lows. Small miners are likely capitulating or going bankrupt as we speak, but the overall hash rate is rising.
Which implies what?
This suggests that the miners plugging in right now aren't mom-and-pop shops running rigs in their garage.
Who are they then?
They are likely very well-capitalized public companies who can afford to burn cash for years. Or even nation-states and massive energy producers who have access to effectively free stranded electricity. They aren't mining for the profit of February 2026. They are securing a strategic position for 2030.
So the network is becoming more industrial.
More sovereign.
Exactly. And purely from a security standpoint, this is incredibly bullish. Some estimates suggest the Bitcoin network now consumes electricity comparable to entire small countries just to maintain this security.
It's crazy.
It makes the network virtually unassailable. You can't hack it. You can't 51% attack it. It has become a digital fortress.
The most secure, most expensive digital vault in the world. Now, speaking of vaults and money, let's talk about where the smart money is actually going. There was a summit recently at Mar-a-Lago, the World Liberty Financial Forum, and the guest list was, let's say, eclectic.
That is putting it mildly. You had the absolute titans of traditional finance there. Goldman Sachs CEO David Solomon, Franklin Templeton CEO Jenny Johnson.
You had crypto royalty like Changpeng Zhao CZ, and then sitting right there in the mix, you had Nicki Minaj.
Wait, Nicki Minaj was at a crypto regulation summit with the CEO of Goldman Sachs. Was she performing or?
No, she was participating. And while it sounds amusing on the surface, it actually highlights how culturally pervasive this conversation has become. It's not just finance geeks in a basement anymore.
Clearly. But the topic wasn't music. It was regulatory uncertainty and tokenization.
Yes, tokenization.
We hear this buzzword every single cycle. We're going to put real estate on the blockchain. We're going to tokenize stocks. But it seems like the big banks are finally taking it seriously.
They are absolutely desperate to enter this space. The message from that room was very clear. They said, we want to tokenize real-world assets, but we need clear rules. They are terrified of the regulatory gray areas in the U.S.
Right.
However, while the U.S. is debating it at Mar-a-Lago with celebrities, other countries are just doing it.
Let's look at Saudi Arabia. They aren't waiting for a forum. They just issued a deed.
Exactly. This is a concrete example that might honestly be more important than the Mar-a-Lago headlines. A Saudi company called GITEX just issued the kingdom's first private sector tokenized real estate deed.
So walk us through this. If I want to buy a piece of a building in Riyadh, how does this actually change things?
Historically, you'd need massive capital to buy the whole building, or you'd have to deal with complex REIT structures and a ton of paperwork. With this tokenized deed, the physical property is legally divided into digital shares on a blockchain.
But is it just a PDF of a deed? Or is it legally binding?
That's the key breakthrough. It's legally recognized. This was done under a formal regulatory sandbox and integrated directly with their national real estate registry. If you hold the token, the law says you own the property.
Wow.
It democratizes access because the entry cost is so much lower. And it makes an illiquid asset, like a massive commercial building liquid, just like trading a stock.
So the U.S. talks and the Middle East executes. That seems to be a recurring theme lately. Now, moving from real estate to the actual plumbing of the internet itself. Vitalik Buterin, the founder of Ethereum, is making some noise about censorship resistance. What is going on there?
Ethereum is undergoing a massive philosophical and technical hardening right now. Vitalik is pushing for an upgrade, specifically something called FOCIL.
FOCIL. F-O-C-I-L. Sounds like something you find on a beach or maybe a dinosaur bone.
Yeah. Crypto loves a terrible acronym. It actually stands for Fork Choice Enforced Inclusion Lists, which is a mouthful of pure jargon, but the concept is absolutely vital for the network.
Break it down for us.
Right now, there's a risk that the powerful actors who build blocks on Ethereum, the block builders, could be pressured by governments to exclude certain transactions, say from a specific country or a politically exposed person.
So a government could say, hey, don't process George's transaction because we don't like him, and the network might actually comply.
Currently, it is a known vulnerability, yes. OCL changes the game completely. It creates a mechanism where a specific list of transactions must be included in the block no matter what.
How does it force them?
It uses these small data blobs, currently they are just 8 kilobytes, to force the network to process them. If a builder ignores the inclusion list, their block gets rejected by the network.
So it's like a mandatory VIP lane that everyone gets access to?
Think of it more like a public utility mandate. It ensures that smart accounts and privacy protocols cannot be discriminated against. It's really about ensuring that Ethereum remains a neutral platform for the entire world, regardless of political pressure.
It's a direct response to the increasing regulatory scrutiny we discussed earlier.
Exactly.
Got it. Making the network uncensorable. Now, for our final deep dive segment, we need to talk about the elephant in the room. Or rather, the supercomputer in the room.
Yes.
There's a massive deal involving Abu Dhabi and India that I think really explains why the crypto markets feel a bit drained of capital right now.
This is the missing piece of the puzzle. We have to talk about where the liquidity is actually going. Abu Dhabi's G42, which is a massive AI holding company, and MBZUAI, the Mohammed bin Zayed University of Artificial Intelligence, are partnering with a U.S. firm called Cerebras.
And they aren't building a crypto mining farm.
No, they are building an AI supercomputer in India, and the specs on this thing are just mind-boggling. They are aiming for 8 exaflops.
8 exaflops. We just learned Zhash, now exaflops. I don't even know how many zeros that is.
It's a lot. An exaflop is 1 quintillion calculations per second.
A quintillion?
Yeah, 8 exaflops is a level of compute that rivals the absolute biggest machines on Earth. But the strategy behind it is what really matters here. This is a sovereign AI play.
Sovereign AI, meaning they're saying we don't want to rely on OpenAI or Google.
Exactly. The deal stipulates that the data stays in India. It aims to democratize AI for India's 1.4 billion people, processing local languages and local data on local infrastructure. It is basically a declaration of independence in the AI age.
That is huge for India. But how does this connect back to my crypto portfolio bleeding out? Why does a supercomputer in Mumbai hurt the price of my DeFi tokens?
Because capital is finite. In 2021, venture capital and speculative money flooded into the metaverse narrative and DeFi. Now all that capital is fleeing towards the AI narrative. We see this in the DeFi stats incredibly clearly.
Give us the numbers.
DX, or decentralized exchange volume, is abysmal. It's hovering around $5 billion daily. To give you context, in 2025, that was regularly hitting 15 or 16 billion.
Wow, a massive drop.
And total value locked TVL is down to 96 billion.
So the liquidity that used to sit in DeFi protocols earning yield is being actively pulled out to fund these massive AI infrastructure projects.
That is the prevailing theory. I mean, why try to earn 4% in a risky DeFi protocol when the entire global economy is pivoting to AI? Plus, there's a really harsh reality check happening right now regarding user experience.
Oh, the UX. Yeah, using DeFi still feels like using the internet in 1995.
It really does. It's clunky, it's scary. You have to manage seed phrases and gas fees. Compare that to the slick, magical user experience of modern AI tools like chatbots. You type a question, it answers.
It just works.
Exactly. The UX gap is severely hurting crypto adoption now that there's a competitor for tech capital that is actually easy for regular people to use.
That is a great point. The shiny object syndrome is real, and AI is very shiny right now.
Very shiny.
So let's recap everything we've covered. We have extreme fear in the markets, but institutional ETFs are buying the dip. We have the U.S. erecting tariff walls and creating a board of peace, while Saudi Arabia is just quietly digitizing real estate.
Right.
Bitcoin is becoming an unassailable fortress of energy, while Ethereum is trying to become a fortress against censorship. And meanwhile, the flashy money is chasing 8 exaflops of AI power in India.
It is a messy transitional moment for sure, but if you zoom out, these aren't separate, disconnected stories. They're all fundamentally about infrastructure.
So what does this all mean for the listener? Is this just the end of crypto?
I really don't think so. I think we are just in a massive clearing of the deck. The speculative fluff, the useless tokens, the bad projects is dying off because the free money is gone.
Good riddance.
Right. But the structural pieces, Bitcoin security, real-world asset tokenization, and sovereign AI compute, they are being built at a record pace.
It's like watching the foundation of a skyscraper being poured while everyone else is complaining that the block party got canceled.
That is a perfect analogy.
Right.
And here is a provocative thought to leave you with.
Let's hear it.
If the world's biggest financial players, like BlackRock and Goldman, are pivoting hard to tokenization, and the world's biggest tech capital is pivoting to AI, is this crypto winter actually just the construction noise for a completely new financial operating system?
A system where an AI agent handles my portfolio of tokenized assets on a secure Bitcoin layer.
Exactly. One where AI agents seamlessly trade tokenized real-world assets on a secure, censorship-resistant layer. That is the ultimate convergence point we are heading towards.
Now, that is a future worth thinking about. We'll be keeping a really close eye on the Board of Peace and that 150-day tariff window. Until then, stay curious.
And keep connecting the dots.
See you on the next deep dive.